All right, very cool. So we got our pause. And let's see if anything is changing over the next few hours in regards to positioning. We'll go to June. Still no cut in June. July, a small possibility for July. And much bigger cut. So 46.9% chance of a cut in September. So the answer is September. Now, most of you said November, but that's the month of the election, and that's very highly unlikely to happen. Like almost 0% chance. Even if they wanted to, they wouldn't cut. What do you think of that? Okay. July, 22% chance. June, 6%, 6.4% chance. Now, this may change over time, but that's how we are instantly after the news. This will update over the next few days as new deals get priced. No cut, cruiser, no cut. And right now, the most likely cut will be September 18th. So put that on your calendar. That is an SEP day. And on SEP days, which are June and then September, I don't cover them live on YouTube. I handle that as part of my Council of Investment Advisors. So I run a crew that invests my money for me. They help me manage my pension fund. It's my corporate retirement account. Cool. I'm also a strategic advisor to 3 endowments. Cool. So if you join that group, you'll be able to learn how to construct and manage portfolios like a hedge fund. So far, the market seems to like it. And I think this has more to do with the runoff reduction. WTF? Well, what that means is the Fed is selling less bonds. And when they sell bonds, they raise yields. Okay, and raising yields is similar to raising interest rates. It's not the Fed funds rate that they're manipulating when they sell. It's more like the 10-year T-note. Okay. So we can go here and we'll try to pay attention to see if this yield comes down. Okay. And it could come down over the next 24 hours because there are less sellers in the market now. Bruce says, why is Dixie not dropping? Again, this is what we're talking about. There are less sellers in the Treasury market. That benefits the Treasury market. That's risk on. Things are a little cheaper, so that's risk on, at least for now. And risk on will be indicative of dollar weakness. Taking a look at the scatter plot, Bitcoin is the biggest loser. Oil is the second biggest loser. Let's get rid of commodities and crypto. And so we'll see if any of this changes to see if any of these things go up. Now, the yield here is down almost 1%, 0.75%. I would imagine this 10-year will drop even further and that's expected, and that's good. NASDAQ might go up. Okay. Isn't that nice? So right now, we've been bearish. There's a bit of a bull run in the next few hours. The big question is, will it only last a few hours, and will you be selling this later? So let's play that game. What if we were bears? Well, based on borrowing sort of what happened earlier today, this would be the sell price. But we have more volatility than that, right? So we bang this out a little bit and see where the resistance is. The next one is going to be about this price. So I suppose the question of the day is, will this be a sell price? Oh, right on, Love World. You've been following me for years. Yeah, I'll be turning 25 soon. You might have known me much of my young adult life. Cool, huh? Cool. So let's take a look at Kiwi dollar. Then we'll look at commodities, and we're waiting for the press conference, of course. And earlier today, we analyzed sonars. What is a sonar? Does anybody know what a sonar is? Something to do with sound. Okay? Well, in particular, we're talking about something like a destroyer floating on the top of the ocean, on the surface of the ocean. And what is it looking for? What does a destroyer use a sonar for? It looks for subs. Are submarines above the destroyer or below the destroyer? Yeah. All right. So at tradars, we have something called sonars, which looks into the past, kind of below. We have radars that look out into the future to see things coming. Sonars look into the past to see patterns. It's looking through the past, below the market. Okay? And what we had analyzed, we looked at all the different things, and we preferred New Zealand dollar for whatever reason. Now, I'm actually a bear on this sucker. And what we said, what we asked it to do is show us the events where the Fed paused. And there was a straight up in 2020, earlier this year. Then late last year, there was an up, a down, and an up. Then there was a down and an up. Then there was a down and an up. This is July 26, 2023. In June, there was a down and an up. In March, there was an up, okay? And in October, there was a down and an up. And am I going too far back, by the way? In December 2022, there was a down and then an up. And these are 15-minute candles. So it suggested New Zealand dollar up on the news. And it just skyrocketed. Okay? And so the thing is, you have to decide, are you going to be a buyer or are you going to be a seller? Now, I knew this yesterday. I knew this a week ago because TradeRs has that ability. Now, it doesn't predict the future. It doesn't say it's going to go up. What it says, and I'll bring it back up, okay? We can draw the following conclusion about the expected movement of Kiwi dollar based on the last 12 Fed interest rate decision events in the United States. If the actual is the same, so no cut, no raise, 66.7% chance that 2-hour trend will be up. And that's that. Now, I'm actually a bear on Kiwi dollar, but I looked at all the other potential opportunities. Aussie dollar said no real scalp. Euro said no scalp. Pound said no scalp. Kiwi said there was going to be a scalp. USD CAD, no scalp. USD Swiss franc, no scalp. USD yen, plausibly a scalp. But I'm a bear on yen. So really, it tells me I don't really get what I want longer term. But okay, and that's a big but. In the past, an event like this produced up 2/3 of the time. Once again, it doesn't mean it'll happen today, and I don't really like it because I want to be selling this pair. At the very least, it says get out of the way and maybe tomorrow. Now, what about tomorrow? Okay, well, Kiwi dollar on a 4 hours before and after is up. So I don't like that either way. But look at some of these other things. 4 hours or 2 days after euro dollar. 2 days. Now look at us zoom out. Okay. And I say, show us the past for euro dollar. Is this going to go up for days and days and days? Well, we don't know, but okay, this is what happened in the past. There was a downtrend, 66% chance on euro dollar, it continues down. So here's what happened in March. It went up for hours and hours and hours and then dropped. This one went down and up and then dropped. This one went down and stayed down. This one went up and then down. This one went up. So that's like what's predicted for today. But 2 days later was lower. Again, it's predicting in the past when the news came out as expected, Kiwi dollar went up for a few hours, but then resumed the downtrend. Remember, right? There was a downtrend. Went up for several hours and then dropped like a ton of bricks. Okay, this went all over the place. Non-farm payrolls came out and then, eventually lower. So anyways, we have all of this past performance. It's not predicting the future, but boy, is it good to know the past. So you might say, well, this is up and there's a scalp. A lot of things are not producing that. But you could look at it from a different point of view and say, well, I don't think anything's really changed, Wayne. And I say, well, I understand your point of view. So how do you use that information? Well, this could go up for hours. And then by the time we hit Friday, be lower than we are now. So you would look to sell a lower high. So one of your strategies could have been, okay, to analyze the last peak to valley and looked at a fib retracement, but what I'm actually looking at is the moving averages. Okay. So that is a valid plan, but that's not a scalp, that's a swing. You also want to eyeball the daily. Where's the daily moving average? So it can actually go a little higher. So here's your plan B, y'all. It goes up to the future 21 EMA on the daily. So it goes up for, let's say, 4 hours. And then at the close of the market, so maybe that's only 2 or 3 hours, or maybe it's in the middle of the press conference, but at some point this rolls over and heads back down. So the last time we had news, does anyone remember what this was? Was it PCE? I think it was income, personal income. But anyways, we had a similar trade plan using a Sonar back here where it was up, but we already knew even if it went up, sell the high. Okay, and there was an 80% chance of down. And well, what it did is it came up, it hit the resistance, and sure as shit through a goose, down she goes. Okay, and the market dropped. And we knew, having seen this result on that piece of news over a dozen times, we knew there was an 80% chance of down based on past performance. Again, not predictive, but at least 80% of the time in the past it fell. Even if it rallied, we knew it, even if it rallied. So we had 2 trade plans on this one. Okay, let's say news, if it dropped, we're going to sell a pullback in the volatility. Or if the news came out and it popped, we're going to sell it high. So you're either going to sell it on the retest or you're going to sell it at the resistance. But you're not going to buy it under any circumstance. Isn't that smoking hot? Do you remember when this was random? Does anybody like trading randomly? I am putting together a presentation I'm going to give you in the next week or two. And we are going to discuss how to remove randomness from your trading. Because if you feel like the market is random and your trading is random, meaning you're a bull, you're a bear, you're a bull, you're a bear, you're a bear, you're a bear, you're a bull, you're a bear, you're a bull, you're a bear. If your trading effectively is random and the market is effectively random, then there's no mathematical possibility you can get consistent results. And if you're not consistent, there is absolutely no way you should be confident. There's a difference between ego and egotism. Ego means you got the facts and you feel confident in your ability. The other one is you don't have ability, you don't have facts, but you're confident anyways. Well, that egotism is dangerous. So I have facts, man. And so if you can build some consistency around those facts by removing randomness, holy smokes, how are you going to feel? Anybody actually want to answer that? How would you feel if we could remove the randomness from your trading? Bring some professionalism to what you do. How will you feel? Yeah. Yeah. Well, I think you should have it, Victor. So I feel bad. There's some people that don't get traders yet. They don't get it. And I've let you down because I haven't created a training course for you. That is going to change. So I apologize for those that have signed up and for whatever reason have canceled. And I think it's because I've failed you, and I apologize. But you're going to re-up. Just be prepared emotionally. You're going to re-up because I'm going to make it so much more valuable. I'm going to make you an offer you can't refuse in the near future. I'm not going to change the price. I'm not going to lower the price. So you can just sign up again and wait, or you can wait and then sign up. But this is like going to radically change the way you trade, the same way TradeRs is ridiculously amazing. Yeah. How many people here want a prop firm, want a prop fund? If I can help you make, let's say, $5,000 a month. How do I feel about prop firms? Well, over the last, let's say about 10 years when they started to first develop, I felt like they were bullshit. Pardon my French. I only curse to make the emphasis. That's the exclamation point at the end of the sentence. Okay? Now, things have changed over the last even just 9 months. But let's say over the last year, things have changed a lot. And I'm incredibly open-minded. And so my plan over the summer is to meet with several of these firms and get things squared away on your behalf. Wayne, where do you find the stuff to work on all this stuff? I don't have any time. That's the problem. But it is, Bruce says, what is a prop fund? By and large, the pitch, and it's not quite true, but it's kind of true. You trade other people's money. It means proprietary. Usually what it means is you run a hedge fund and you trade client money. And then you become so wealthy that you don't want to deal with clients anymore. And you're like, you know what? Instead of trading $10 billion, you now have a net worth of $100 million, and you could just trade $100 million and keep 100% of that and make more than enough money to live the life you want, and you don't have any clients anymore. It's just like, phew, easy. You just keep doing what you're doing, but without the stress and the expense of large teams and compliance of the yin yang and bitchy clients. How come you only made me 20%? I have this other group that does 30. And they don't understand that the other firm is degenerate gamblers, right? So you have to deal with all that nonsense. Okay. Now Todd says they take all the downside risk and you get all the upside. Yeah, well, whatever. You know, I am super skeptical. But if I can find, let's say, 3 firms, and they can show me what they're doing is compliant, and they're cutting checks. I mean, I want to see people making 5, 10, 15, 20 grand a month. If they're doing that, then I will help you get set up. I was going to create a course, and we talked about this 2 or 3 years ago. I was going to create not a course, but a program where I help you get incorporated as a hedge fund offshore. At some point, you would also need an onshore entity. Usually you set up a manager in Delaware, but then you set up the fund in the Caymans. Let's say that a buddy of mine has a structure like that. And then you get all that squared away, and then you have to get set up with compliance. And then you got to start your fund. And so now we're at about $55,000 to $75,000 startup cost. And now once you're all structured and legal and you have all your documents, then you need to go out and raise money. And along the way, you're going to get audited. You're going to get audited in your first year, and you're going to get audited probably around year 5. And that's going to cost you a lot of money. Meanwhile, you only keep 20% of the profits. And if you're conservative and disciplined like I teach you, then you're only doing, let's say, 20% a year. So $1 million, 20% is 200,000, and 10% of 200,000 is 20. 20% is 40. So you only made 40 grand. You can't even pay the bills. And so if I said to you, well, after you spend the 75,000, you got to go out and raise somewhere, around 25 million before you could even make, let's call it somewhere around minimum wage. And you're like, golly. And then you're like, but Wayne, I don't know anything about sales and marketing. I can't get up and do a pitch. I can't close a deal. I don't know how to do sales. I don't like public speaking. Well, it's going to be very difficult to raise 25 mil, yet alone 100 mil, right? And 100 mil is where you go from sort of a tiny little hedge fund to something like not tiny. It's not even big. But there is 100 million is the line in the sand in the industry, right? So for some of you, you're like, dude, I don't have 75 grand and there's no way I can raise 25 million. Well, not in the beginning. You don't have a track record, for example. And you don't have that kind of disposable income. Okay, gotcha. So how do we fill that gap? And that's where the props come in. So if I can somehow vet, like not legally vet, I'm not your advisor, but if I can go out and at least check these guys out, and then set up a program, my vision is you have a coaching team like myself working for you every day. You have training videos to help you refine your skills whenever you need it. You have QuantBox to help you form your fundamental bias and uncover the intrinsic underlying trend in the market right now. You have Tradars as a virtual assistant to do technical analysis for you on 7,500 charts in real time. And I get you your first $100,000 trading account. And it's all under one house. Would you join my team if I could provide all of that to you? Hey, Manus. What's up, buddy? Well, it's happening. So when I say like, if Tradars looks amazing, but you don't know how to use it, join or rejoin if you checked it out and quit. Rejoin. I'm telling you, you and I are going to change the world. And I am not joking about that. Now, I can't change everybody's world, but I can change your world. Some of these firms are talking about guys making 20 grand a month. I want that to be you. Okay? Cool. So going back to what Traders was telling us, do you remember the Kiwi dollar and the euro dollar? Up. The initial response is up. Now, there wasn't an up scalp on euro dollar, but there was an up scalp on Kiwi dollar. I don't like Kiwi dollar right now. So I don't know if I even want to take that. But you see, that's a boss attitude. But right now, it's got you from the 50% back to the water or to the neckline. You guys remember this from my book? Okay, there's a sniper trade. Do you guys remember? The sniper trade, taking this trade from afar. And then there's the bayonet trade, which produces more like this. And what I teach is the sniper. And then if this one, okay, take long. Now, the other part that's in my book is you buy it here, but when you get to this line, which we just hit, you move your stop to break even. Okay? That's that. Now, press conference is on. Thank you, Hervé. My point here is I'm a bear on this pair. I'm a bear. I'm a bear. I'm a bear on this pair. I'm a bear. So I don't have to buy it at all. I can sell it later today. I can sell it tomorrow. If it goes up, I like it going up. Go up, bro. Go up. Okay? And I want to sell it off that future 4-hour 21. And if you recall what I did, I thought I did it on this pair. I must have done it on the other pair. I have a selling price there, and I have a selling price there. And then I highlighted it, right? Where is it highlight? I highlighted it. Okay? Like a boss, not like an amateur. How many people here want to trade like a boss? Where you say, oh, up? Yeah, I think I'll pass. And you're doing it because you got the intel.
Purchases, which excludes inventory investment, government spending, and net exports, and usually sends a clearer signal on underlying demand, was 3.1% in the first quarter, as strong as the second half of 2023. Consumer spending has been robust over the past several quarters, even as high interest rates have weighed on housing and equipment investment. Improving supply conditions have supported resilient demand and the strong performance of the U.S. economy over the past year. The labor market remains relatively tight, but supply and demand conditions have come into better balance.
Can you hear okay?
Payroll job gains averaged 276,000 jobs per month in the first quarter, while the unemployment rate remains low at 3.8%.
Thank you.
Strong job creation
Oh, hey, please click the thumbs up button, huh? Tell YouTube this is good.
Reflecting increases in
I'm going to get slapped for running this, so I'm not doing it for money.
4 years, and a continued strong pace of immigration. Nominal wage growth has eased over the past year, and the jobs-to-workers gap has narrowed, but labor demand still exceeds the supply of available workers. Inflation has eased notably over the past year, but remains above our longer-run goal of 2%. Total PCE prices rose 2.7% over the 12 months ending in March. Excluding the volatile food and energy categories, core PCE prices rose 2.8%. The inflation data received so far this year have been higher than expected. Although some measures of short-term inflation expectations have increased in recent months, longer-term inflation expectations appear to remain well anchored, as reflected in a broad range of surveys of households, businesses, and forecasters, as well as measures from financial markets. The Fed's monetary policy actions are guided by our mandate to promote maximum employment and stable prices for the American people. My colleagues and I are acutely aware that high inflation imposes significant hardship as it erodes purchasing power, especially for those least able to meet the higher costs of essentials like food, housing, and transportation. We are strongly committed to returning inflation to our 2% objective. The committee decided at today's meeting to maintain the target range for the federal funds rate at 5.25% to 5.5%.
We hit that second line.
Significantly reducing our securities holdings, though at a slower pace. Over the past year, as labor market tightness has eased and inflation has declined, the risks to achieving our employment and inflation goals have moved toward better balance. The economic outlook is uncertain, however, and we remain highly attentive to inflation risks. We've stated that we do not expect that it will be appropriate to reduce the target range for the federal funds rate until we have gained greater confidence that inflation is moving sustainably toward 2%. So far this year, the data have not given us that greater confidence. In particular, and as I noted earlier, readings on inflation have come in above expectations. It is likely that gaining such great...
We have those expectations in QuantBox, by the way.
We are prepared to maintain the current target range for the federal funds rate for as long as appropriate. We're also prepared to respond to an unexpected weakening in the labor market. We know that reducing policy restraint too soon or too much could result in a reversal of the progress we've seen on inflation. At the same time, reducing policy restraint too late or too little could unduly weaken economic activity and employment.
These are the expectations.
In considering any adjustments to the target range for the federal funds rate, the committee will carefully assess incoming data, the evolving outlook, and the balance of risks. Policy is well positioned to deal with the risks and uncertainties that we face in pursuing both sides of our dual mandate. We will continue to make decisions meeting by meeting. Turning to our balance sheet, the committee decided at today's meeting to
This is
slow
the big news.
decline in our securities holdings, consistent with the plans we released previously. Specifically, the cap on Treasury redemptions will be lowered from the current $60 billion per month to $25 billion per month as of June 1.
It's max, I'm
Consistent
sorry.
with the committee's intention to hold primarily Treasury securities in the longer run, we're leaving the cap on agency securities unchanged per month, and we will reinvest any proceeds in excess of this cap in Treasury securities. With principal payments on agency securities currently running at about $15 billion per month, total portfolio runoff will amount to roughly $40 billion per month. The decision to slow the pace of runoff does not mean that our balance sheet will ultimately shrink by less than it would otherwise, but rather allows us to approach its ultimate level.
Oh, I didn't do that. Anyways, notice Tradars has 59.11. We just hit 59.12, 59.15.
Facilitating the ongoing.
All right, I'm going to move to Plan B.
Howard Schneider with Reuters. A question to follow up, if I could. Do you consider the current policy rate still, are you confident that it's sufficiently restrictive to get inflation back to 2%?
So I do think the evidence shows, pretty clearly that policy is restrictive and is weighing on demand. And there are a few places I would point to for that. You can start with the labor market.
It's gorgeous, isn't it?
Still strong, the demand side of the labor market in particular.
It's incredible, isn't it?
Cooled from its
You
extreme
might have thought the
level
dollar was
years
going to
ago.
get
And you
strong.
see that in job openings. You saw more evidence of that today in the JOLTS report, as you'll know. It's still higher than pre-pandemic, but it has been coming down both in the Indeed report and in the JOLTS report. That's demand cooling. The same is true of quits and hiring rates, which have essentially normalized. I also look at we look at surveys of workers and
Yeah, I think I can turn down my mic if I can't turn
workers,
them
are
up.
jobs plentiful, and ask businesses,
Is that a
are
little
workers
better? I do
plentiful? Is
tend
it
to
easy
yell.
to find workers? And you've seen that the answers to those have come back down to pre-pandemic levels. You also see in interest-sensitive spending like housing and investment, you also see that higher interest rates are weighing on those activities. So I do think it's clear that that policy is restrictive.
Sufficiently restrictive, I guess. Is the word.
So I would say that we believe it is restrictive, and we believe over time it will be sufficiently restrictive. That will be a question that, that the data will have to answer.
So as a follow-up, if inflation
Pardon me.
continues running roughly sideways as it has been, the job market stays reasonably strong, unemployment low, and expectations are anchored and maintained, would you disrupt that for
Expectations are not anchored.
or anchored?
Or anchored.
Stable, roughly. Would you disrupt that for the last half point on PCE?
I don't want to get into
Telling you, sign up for
complicated hypotheticals, but
tradars.co.
I would say that, we're
I
committed to
will increase the
retaining our
value
current
proposition in the next
restrictive
few
stance
weeks
of policy for as long as
dramatically.
is appropriate, and we'll do that.
Gina.
I'm going to give you lots of love.
Thanks for taking our questions, Chair Powell. I wonder, obviously, Michelle Bowman has been saying that there is a risk that rates may need to increase further, although it's not her baseline outlook. I wonder if you see that as a risk as well, and if so, what change in conditions would merit considering raising rates at this point?
So I think it's unlikely that the next policy rate move will be a hike. I'd say it's unlikely. Our policy focus is really what I just mentioned, which is how long to keep policy restrictive. You ask, what would it take? I think we'd need to see persuasive evidence that our policy stance is not sufficiently restrictive to bring inflation sustainably down to 2% over time. That's not what we think we're seeing, as I mentioned. But that's something like that is what it would take. We'd look at the totality of the data to answer that question. That would include inflation expectations, and all the other data too.
Would that be like a reacceleration in inflation?
Well, I think, again, the test, what I'm saying is if we were to come to that conclusion that policy weren't tight enough to achieve that, so it would be the totality of all the things we'd be looking at. It could be expectations, it could be a combination of things, but if we reach that conclusion and we don't see evidence supporting that conclusion, that's what it would take, I think, for us to take that step.
We want to watch 5940, 5950.
Thank you, Chris Rugaber at Associated Press. You didn't mention the idea that rates are at a peak for the cycle, and didn't mention the idea that it might be appropriate to cut rates later this year, as you have at previous press conferences. So has the Fed sort of dropped its easing bias? Where are you standing on that?
So on, let me address cuts. So obviously, our decisions that we make on our policy rate are going to depend on the incoming data, how the outlook is evolving, and the balance of risks, as always. And we'll look at the totality of the data. So I think, and we think, that policy is well positioned to address different paths that the economy might take. And we've said that we don't think it would be appropriate to dial back our restrictive policy stance until we've gained greater confidence that inflation is moving down sustainably toward 2%. So, for example, let me take a path. If we did have a path where inflation proves more persistent than expected and where the labor market remains strong, but inflation is moving sideways and we're not gaining greater confidence, well, that would be a case in which it could be appropriate to hold off on rate cuts. I think there's also other paths that the economy could take which would cause us to want to consider rate cuts, and those would be, two of those paths would be that we do gain greater confidence, as we've said, that inflation is moving sustainably
Or if something breaks.
2%. And another path could be, an unexpected weakening in the labor market, for example. So those are paths in which you could see us cutting rates. So I think it really will depend on the data. In terms of peak rate, I think really it's the same question. I think the data will have to answer that question for us.
Well, and could you just follow on the path where you might not cut? Is that, you mentioned that it would be inflation persistent. Is inflation, would that be the key data in making that decision, or could you expand a bit more on that? Thank you.
Again, we've set ourselves a test that for us to begin to reduce policy restriction, we'd want to be confident that inflation is moving sustainably down to 2%. And for sure, one of the things we'd be looking at is the performance of inflation. We'd also be looking at inflation expectations. We'd be looking at the whole story, but clearly incoming inflation data would be at the very heart of that decision.
Nick Timrose of the Wall Street Journal. Chair Powell, to what extent has the easing in financial conditions since November contributed to the reacceleration in growth? And do you now expect a period of sustained tighter financial conditions will be needed to resume the sort of disinflation the economy saw last year?
So I think it's hard to know that. I think we'll be able to look back, from down the road and look back and understand it better. If you look at, let's look at growth. Really, what we've seen so far this year in the first quarter is growth coming in about consistent with where it was last year. I know GDP came in lower, but you don't see an acceleration in growth. I mean, the thought would be that financial conditions loosened in December, and that caused an uptick in activity, and that caused inflation. Presumably, or tightening in the labor market. You don't really see that happening.
Okay,
what you see is
we're at a very
economic
toppish
activity
zone
at a level that's roughly the same as last year. So, what's causing this inflation, we'll have a better sense of that over time. I don't know that there's an obvious connection there, though, with the easing of financial conditions. In terms of tightening, you're right. I mean, rates are certainly higher now and have been for some time than they were before the December meeting, and they're higher, and that's tighter financial conditions. And
This email came
that's
out
appropriate given what inflation has done in the first quarter.
You've said in
4
the
minutes
past
ago.
that stronger growth wouldn't necessarily preclude rate cuts. I wonder, would continued strength in the labor market change your view about the appropriate stance of policy if it was accompanied by signs that wage growth was reaccelerating?
So I just want to be careful that we don't target wage growth or the labor market. And remember what we saw last year: very strong growth, a really tight labor market, and a historically fast decline in inflation. So and that's because we know there are two forces at work here. There's the unwinding of the pandemic-related supply side distortions and demand side distortions, and there's also monetary policy, restrictive monetary policy. So I wouldn't rule out that something like that can't continue. I wouldn't
Very
give up
toppish
at
off
this
that
point
pivot
on
point.
further things happening on the supply side, either because we do see that that companies still report that there are supply side issues that they're facing, and also even when the supply side issues are solved, it should take some time for that to affect economic activity and ultimately inflation. So there are still those things. So I don't like to say that either either growth or a strong labor market in and of itself would automatically create problems on inflation, because of course it didn't do that last year. You ask about wages. We also don't target wages. We target price inflation. It is one of the inputs. The point with wages is, of course, we like everyone else like to see high wages, but we also want to see them not eaten up by high inflation, and that's really what we're trying to do, is to cool the economy.
Next
and
level is
work with
closer
what's
to
happening on
50.
the supply side to bring the economy back to 2% inflation. And part of that will probably be having wage increases move down incrementally toward levels that are more sustainable.
Rachel.
Hi, Chair Powell. Rachel Siegel from the Washington Post. Thanks for taking our questions. You talked about needing time to gain more confidence that inflation is sustainably moving back down to 2%. It's May now. Do you have time this year to cut 3 times, just given the calendar?
Yeah, I'm not really thinking of it that way. What we said is that we need to be more confident, and we've said, my colleagues and I today said, that we didn't see progress in the first quarter, and I've said that it appears then that it's going to take longer for us to reach that point of conference. So I don't know how long it'll take. I can just say that when we get that confidence, then rate cuts will be in scope, and I don't know exactly when that will be.
And with hindsight, are there any signs that you can look back on now, looking at the reports from January or February or March, that suggested something more worrying than just expected bumpiness?
Not really. So I thought it was appropriate to reserve judgment until we had the full quarter's data, until we saw the March data. And so take a step back. What do we now see in the first quarter? We see strong economic activity. We see a strong labor market, and we see inflation. We see 3 inflation readings. So I think you're at a point there where you should take some signal. We don't like to react to 1 or 2 months' data, but this is a full quarter, and I think it's appropriate to take signal now, and we are taking signal. And the signal that we're taking is that it's likely to take longer for us to gain confidence that we are on a sustainable path down to 2% inflation. That's the signal that we're taking.
Steve.
Yeah, Mr. Chairman, if I could, Steve Leisman, CNBC, if I could follow up on that. What particular areas were sort of temporary or blips in the inflation data in the first quarter? And what's the dynamic by which you expect them to work out in the coming months and quarters?
Yeah.
You might be talking about the low GDP.
We will we have put the thing under a microscope. I will say nothing is going to come out of that that's going to change the view, I think, that in fact we didn't gain confidence and that it's going to take longer to get that confidence. But confidence, I just think, you know the story. What's happened since December is you've seen higher goods inflation than expected, and you've seen higher non-housing services inflation than expected, and those two are working together to sort of be higher than we had thought. And there are stories behind how that happened. I think my expectation is that we will, over the course of this year, see inflation move back down. That's my forecast. I think my confidence in that is lower than it was because of the data that we've seen. So we're looking at those things. We also continue to expect, and I continue to expect, that housing services inflation, given where market rents are, those will show up in measured housing services inflation over time. We believe that it will. It looks like that there are substantial lags between when lower market rates turned up and for new tenants, and when it shows up for existing tenants or for in housing services. So,
If I could just follow up, is there a bit of a contradiction in the idea that you are reducing quantitative tightening, which is sort of an easing, while you're holding rates steady at a restrictive rate to try to slow and cool the economy and inflation? Thank you.
I wouldn't say that, no. I mean, the active tool of monetary policy is, of course, interest rates. And this is a plan we've long had in place to slow, really not in order to, provide accommodation to the economy, but to be less restrictive to the economy. It really is to ensure that it doesn't wind up with financial market turmoil the way it did the last time we did this, and the only other time we've ever done this.
Craig.
Craig Forrest from Bloomberg. Two questions. First, simple one. Given the run of data since March, has the probability in your mind of no cuts this year increased or stayed the same? That's the first question. Second question. Chair Powell, you joined the board in 2012, and I'm sure you remember, as I do, what the jobless recovery was like. Lawyers, accountants, all kinds of highly qualified people who couldn't get jobs. And given your history there, I wonder if there's an argument for being more patient with inflation here. We have strong productivity growth. That's helping wages go up. We have good employment. And so it seems to me there's a lot of hysteria about inflation. I agree, it's, nobody likes it, but is there an argument for being patient and working with the economic cycle to get it down over time? Thank you.
So on your first question, I don't have a probability estimate for you, but all I can say is that, we've said that we didn't think it'd be appropriate to cut until we were more confident that inflation was moving sustainably at 2%. Our confidence in that didn't increase in the first quarter, and in fact, what really happened was we came to the view that it will take longer to get that confidence. And I think I think it's the economy has been very hard for forecasters broadly to predict its path, but there are paths to not cutting, and there are paths to cutting. It's really going to depend on the data. In terms of the employment mandate, to your point, if you go back a couple of years, our sort of framework document says that when you look at the two mandate goals, and if one of them's further away from goal than the other, then you focus on that one. It's the time to get back there times the times how far it is from the goal, and that was clearly inflation. So our focus was very much on inflation. And this is what we referred to in the statement. As inflation has come down now to below 3% on a 12-month basis, it's become we're now focusing the other goal, the employment goal, now comes back in to focus, and so we are focusing on it, and that's how we think about that.
Claire.
Claire Jones, Financial Times. Thanks a lot for the opportunity to ask the questions. Just to go back to the answer before the previous one, it seemed to suggest that you think the likeliest path of inflation is one that's going to allow you to have a situation where rates are lower at the end of the year than they are right now. It'd be good if you could just confirm whether or not that's a correct reading. And the Q1 GDP print has led to some to start mentioning the term stagflation with respect to the US economy. Do you or anyone else on the FOMC think this is now a risk? Thank you.
Yeah, I'm not dealing really in likelihoods. I think there are paths
All right,
that
we
the
hit the
economy
line
can
in the
take
sand.
that would involve cuts in their paths
What do you
that
think?
wouldn't.
What do you think?
And I don't have great confidence in which of those paths. I think I would say my personal forecast is that we will begin to see further progress on inflation this year. I don't know that it will be sufficient. I don't know that it won't. I think we're going to have to let the data lead us on that. In terms of your second question was stagflation. I guess I would say I was around for stagflation, and it was 10% unemployment. It was high single digits inflation. Right now we have very slow growth. So right now we have 3% growth, which is pretty solid growth, I would say, by any measure, and we have inflation running under 3%. So I don't really understand where that's coming from. And in addition, I would say most forecasters, including our forecasting, was that last year's level of growth was very high, 3.4% in, I guess, the fourth quarter, and probably not going to be sustained and would come down. But that would be our forecast. That wouldn't be stagflation. That would still be to a very healthy level of growth. And of course, with inflation, we will return inflation to 2%, and that won't be. So I don't see the stag or the inflation, actually.
Michael McKee from Bloomberg Radio and Television. The vice chair of the FOMC said recently that he's willing to consider the idea that potential growth has moved up, and of course he's Mr. Potential Growth, our star. Do you share that view, and would that imply that maybe policy isn't tight enough?
So I think I would take that question this way. We saw a year of very high productivity growth in 2023. And we saw a year of, I think, negative productivity growth in 2022. So I think it's hard to draw from the data. The question is, will productivity run? There are two questions. One is, will productivity run, persistently above its longer run trend? I don't think we know that. In terms of potential output, though, if that's a separate question. We've had what amounts to a significant increase in the potential output of the economy that's not about productivity. It was about having more labor, frankly, both through, in 2023, both through participation and also through immigration. So we're very much like other forecasters and economists getting our arms around what that means for potential output this year and next year and last year, for that matter, too. So I think in that case, I think you really do have a significant increase in potential output. But you've also got so you've got more supply, but those people also come in, they work, they have jobs, they spend, so you've also got demand. So it may be that you get
remember,
more
this has
supply than
already
you get
worked.
demand at the
We've already
beginning,
hit
but
target on
ultimately,
this one.
It should be neither inflationary nor disinflationary over a longer period.
Well, you said earlier that at this point, you're not really considering rate increases. If growth is higher, but you're not considering rate increases, does that imply that you're more worried about causing the economy to slow too much than you are about inflation taking off again?
No, I think we believe our policy stance is in a good place and is appropriate to the current situation. We believe it's restrictive.
dollar was supposed to go up to 107.
Our evidence for that I went over earlier. You see it in the labor market, you see it in inflation-sensitive spending, where demand has clearly come down a lot over the past few years. And that's more from monetary policy, whereas the supply side things that are happening are more on the supply side. So
We're up even
that's
30
how I would
pips
think about it.
beyond what traders pointed you towards.
Thank you, Mr. Chairman. Edward Lawrence from Fox Business. So
see?
GDP growth is about 2%. Inflation,
this before,
employment is about 4%. It feels a
to
lot like a
107.
steady state, and we have 3% inflation. So if the data remains the same that you're seeing, and I know you said you don't see a rate hike, but it stands to reason that you would need a rate hike to get from 3 to 2% inflation. So was there any discussion about a rate hike in today's meeting? And are you satisfied with 3% inflation for the rest of the year?
Well, of course, we're not satisfied with 3% inflation. 3% can't be in a sentence with satisfied. So we will return inflation to 2% over time, but over time. And we think our policy stance is appropriate to do that. So if we were to conclude that policy is not sufficiently restrictive to bring
This is
inflation
USD yen.
sustainably down to 2%, then
Remember,
that
we
would
had
be
this
what it would
before
take
the
for us
news
to
came
wanna
out. We had
increase
this
rates.
yesterday.
We don't see that. We don't see
We
evidence
had
for
it
that.
the day before. We had
So
it the day
that's where we
before
are.
The
that.
discussion, was there a discussion about a rate hike at all?
So the policy focus has really been on what to do about
Looks like
uh,
157.
holding
We
the
got
current
down to
the
150.
current level
Yeah.
of restriction. That's really that's part of the policy.
157.08.
That's where the policy discussion was in the meeting.
Yeah, I wanted to follow on the 3%. Is there a time frame of persistent inflation that would
That's
trigger
about
a rate
here.
hike?
There isn't any rule. You can't look to a rule.
Let me know if that's
these are going
wrong.
to be judgment calls. Clearly restrictive monetary
My
policy
gosh,
needs more
remember,
time
you
to do
knew
its
this
job.
a week ago.
That is pretty clear based on what we're seeing. How long that will take and how patient we should be, it's going to depend on the totality of the data, how the outlook evolves.
Victoria.
Hi, Victoria Guido with Politico. You've talked about your commitment to being apolitical and nonpartisan, and I was just wondering, given that it's an election year, is the bar for rate changes higher close to an election? And similarly, is there a significant economic difference between, starting to cut in, say, September versus December?
What do you think, guys? Are you in?
So we're always going to do
convinced?
what we think the right thing for the economy is when we come to that consensus view that it's the right thing to do for the economy. That's our record. That's what we do. We're not looking at anything else. It's hard enough to get the economics right here. These are difficult things, and if we were to take on a whole nother set of factors and use that as a new filter, it would reduce the likelihood we'd actually get the economics right. So that's how we think about it around here. And we're at peace over it. We know that we'll do what we think is the right thing when we think it's the right thing, and we'll all do that. And that's how everybody around here thinks. So I can't say it enough that we just don't go down that road. If you go down that road, where do you stop? And we're not on that road. We're on the road where we're serving all the American people and making our decisions based on the data and how those data affect the outlook and the balance of risks.
And then is there a significant difference between, whether you start in, say, September versus December? An economic
There's a
difference?
significant difference between an institution that takes into account all sorts of political events.
I'm all in
and one
with
that doesn't.
traders, guys.
That's where the significant difference is. And
I'm
we just don't do that.
in.
I mean, you can go back and read the transcripts for this is my fourth presidential election here. Read all the transcripts and see if anybody mentions
This is the
in any
future
way
of trading.
the pending election. It just isn't part of our thinking. It's not what we're hired to do. If we start down that road, I don't know how you stop. So
I'm all in. All in. Look at it come down
Thank you, Chair
my
Powell.
zone.
Question about the labor market. You've mentioned a few times that the labor market is normalizing. Certainly today's JOLTS data suggested that things are kind of getting back to pre-pandemic levels. One thing that hasn't normalized is wage growth, which is still quite a bit stronger than before the pandemic. I wonder if you can share your analysis of why that's happening. Is it a lagging indicator or something else going on?
I think if you go back to where wages peaked, wage increases peaked a
seriously,
couple, 3
look
years
at
ago.
this. It's
Essentially,
ridiculous.
all wage measures have come down substantially to that. But they are not down to where they were before the pandemic. They're still roughly a percentage point higher. And we've seen pretty consistent progress, but not uniformly. And you'll note the ECI reading from Tuesday was expected to have come down, and essentially it was flat year over year, I think, roughly. So, yeah, I mean, that part of it is bumpy. And again, we don't target wage increases, but in the longer run, if you have wage increases running higher than productivity would warrant, and then there will be inflationary pressures. Employers will raise prices over time if that's the case. So we've seen progress. It has been inconsistent, but we have seen a substantial decline overall. But we have ways to go on that.
Scott.
All right, I think we know this.
Nancy.
I think we can pause this, can't we? All right, cool. Did anything fundamentally change? That's for you to decide. On the long, what the big news is the Fed is not in a situation where they want to cut. They want to cut sometime in the future. They just don't know when. Okay? So, what do you want to do the rest of the month? So this is the 1st of May. What do you want to do in May? Are you buying dollar or selling dollar? Please answer. Just type it in the chat. Let's have 110 people answer this. For the rest of the month, are you buying dollar or selling the dollar? Selling is risk on. Buying is risk off. Are you buying the dollar or selling the dollar? Okay, risk off is buying. Risk on is selling. Okay. You're going to hire an assistant to watch 7,500 charts for you in real time. Let me show you how to do it. You've decided that you're a buyer of the dollar or the seller of the dollar. That's it. You've decided. And we can go here, turn on all the Forex pairs, but now you want to do buy dollar. Okay, looks like most of you want to buy dollar. So you can say, hey, virtual technical analyst. Okay, this is somebody working for you. Just happens to not be a body. Okay, you have an entity watching 7,500 charts, but you're like, look, I want to do risk off by dollar. So you get rid of Aussie CAD and you're not interested in cross pairs. You're not interested in yen. You're not interested in cross pair. Oh, that one, but not this one, not that one, not that one, not that one. So you're in boss mode. You're not interested in euro pound. Well, what if you get a technical trade pattern? Do you understand that there's going to be bullish and bearish patterns across all of these? You must understand that. And they're valid. They're real. AI does not make a mistake. Okay? Just like Elon Musk will say, autopilot is a better driver than you because it takes you almost a second and a half to see danger and slam on the brakes, where AI can hit the brakes 1,000,000 times in 1 second. Okay? It can do better technical analysis. It never makes a mistake. It follows the pattern rules or it doesn't. It's either a pattern or not a pattern, but it also watches every pair on every time frame. So your job is to find out what you are not interested in. So there's a two-step process, if you will. Kill the things you're not interested in. Okay, those are all dollar pairs. Step 1. Step 2, you're only interested in buying dollar. OC says, I will be data dependent. What are you talking about? You have all the data. What data? They just told you, OC. So data dependent sounds smart, but dude, it doesn't make any sense. What data? You already have the data. You want the next Fed meeting? No, I'm talking about the next 5 weeks. May is a long month. What are you going to do this month? You just found out the Fed told you. You have all the data. Okay? So, anyways, you decided, you guys, the vast majority of you, about 90% of you, said you want to buy dollar. Okay, this says sell dollar. Do you want it? No, ignore it. This says sell dollar. Do you want it? No, ignore it. This says buy dollar. Well, I mean, buy euro dollar, but that's sell dollar. But you want to buy dollar, ignore it. Ignore it, ignore it, ignore it. You are the decision maker. You're the boss. This is just your technical analyst. And the job of the technical analyst is to show the patterns, not to decide whether you should buy or sell. So these are all valid patterns. This is an ABCD emerging pattern. It is. Oh, and it's a buy dollar scenario. So it's suggesting sell the rip. Now notice it updates. So this pattern came out 42 minutes ago before the news. Then look at it's updated since. You see the giant green candles? Since the news. This is updated. It's already updated. The pattern presented itself. It's an emerging pattern. If A, B, C leads to a D, then there's a high probability of down on the 4-hour chart. So that's a giant maybe. Put it in the parking lot, go open your chart and consider it maybe when you decide the next wave occurs, aka 5-minute chart, 2155 cross down. Now you're going to tiptoe into the position because you like this one. You like this one. This one is definitely a down channel, and you definitely don't want it because you've already decided you're a buyer of the dollar, not seller. So stop chasing patterns. Be the boss. This is just your intern. Okay? Slap your intern on the ass and give him a Jamba Juice or a Starbucks gift card and say, good job, fella. Well, don't do the whole slap on the ass thing. You probably get in trouble. Okay? The use of interns have changed since Clinton's day. All right, euro dollar up, 4-hour chart. Pass, not interested. Nice little channel. But what if you opened your chart? Remember, this is an emerging pattern. It might develop. It's going up now. But what if you're watching your chart, it comes up to 107, then drops? Cool. That might be useful to you because you're already a bear and this pattern failed. And notice what the pattern is. You're smart enough. You know technical analysis. What is it really telling you? Come on, think forward. It saw support, so it's going to go up to resistance. And that's all it's saying, up until resistance. But what happens when it gets to 107.20? It probably is going to look like that. And by the way, that is where we are now. So shields up, red alert, open your charts and start making trading and investing decisions. Knowing that actually, even though this is saying up, it is a channel down. So you sell at the top and target lower. So I can even think forward on this. If this falls at 107.20, we're probably going to head down to 106.20. Cool. Open up your chart. It's showing you the pattern. It is a down channel. Therefore, if you are a bear, you sell high. Nonetheless, it's just like, hey, boss, look, there's a down channel. So if it goes up, then the next move is down, right? Make a decision. And notice it's only showing you now, which one is it? Euro dollar, 4-hour chart. It emerged 3 hours ago. Now, it's saying up to the top of the channel, but I'm a bear, and since I'm a bear and my intern, my analyst, yeah, it's buying because it's going to go to the top of the channel. Right, Fox Eye? But I don't buy it because it noticed a down channel and price action moving up. That doesn't make me buy. I'm smarter than that. That is real. That pattern exists. It gets me in tune to the fact that the top of the channel is around 107.20, and somewhere around there on my 5-minute chart, I should look for a reversal pattern. but I'm the boss. So you don't, I mean, you could scalp this up and pick up a few pips. That's not what I do. That's not how the Wayne do. I'm a bear, and in a down channel, I sell. But that's me. But I'm a boss. Okay? So on and so forth. You see that? And so, like, right now, there's probably not a lot of amazing things going on. We'll figure it out. We'll figure it out. This will all change. But when will all this change? This says sell, but it's based on old price action. This says sell. This is based on old price action. You can see this just rallied up. Euro dollar, look, traders had already pointed you up to 107.30. It's a different analysis on a different time frame. It's a different pattern up to resistance. So it's just, it's either hit this target or got very close. Look, an hour ago, it said buy it with a target of 107.31. Okay? But it's resistance. So what would you look for if you were a bear? Bearishness. What would traders do? If it notices a pattern, there's a minimum of 15 patterns, not including things like Fibonacci and Gartley's and all these different things, which are just another form of, Fibonacci. It's ignoring all of those because those are momentum patterns. They're not like reversal patterns. This is a breakout pattern. So this is retracing back to support. This is retracing back to resistance. Okay? That's a type of pattern. The next pattern is, well, what about a reversal pattern? So if this went up to resistance around 107.31, think of it. And then traders noticed, probably on a 15-minute chart first, a reversal pattern. Then it's real. A real reversal pattern with real rules of engagement, with real like double tops and lower lows and lower highs. And if it sees it, it's real. It doesn't make mistakes. It follows rules perfectly. So imagine now you're in boss mode and you want to sell euro dollar and the sucker just spiked up 50, 60 pips. Great. You sit on your hands, Potsy. And it spikes all the way to 107.31. And you're like, cool, that's an interesting resistance level. I wonder if it'll roll over. You open up your 5-minute chart and you look for the trade. But meanwhile, traders is also watching the same thing and everything else. And it'll tell you, hey, boss, I just noticed on euro dollar some sort of reversal pattern, whatever it is. Like I said, there's 15 patterns. What if it developed a 15-minute head and shoulders pattern? It will tell you. And it'll tell you before it forms. It'll tell you that it's emerging. And then once it has emerged, it can then look in the past and show you how reliable that pattern is. So you go like to euro dollar or something, and it'll say, like, of course, there's not going to be a head and shoulders here, but if all these patterns, it'll notice, but it'll also show you now that it's in play. Okay, you were notified. Earlier today, you were notified about this. And there's a 67% probability. This one has an 80% probability, 68% probability, 66% probability. You know what, traders? Hey, technical analyst. Hey, assistant. Hey, grunt. Remember, it just does all the grunt for you. Grunt. I'm only interested in 75% or above. Sir, yes, sir. 80%, 81%, 76%, 81%. Hey, analyst. Hey, grunt. Give me some crypto. Oh, there's only one that I see on Bitcoin, and it's down. Oh, okay. Hey, grunt. Give me some stock indices. There's only one. Nikkei. Hey, grunt. Show me some commodities. Crude oil and Brent oil. 75%, 75%. Hey, Grunt, I like to trade stocks. Give me some stocks. Okay? Chevron and Netflix. Dude, it's doing so much. Okay, 78% chance of down to 155 on Chevron. Holy smokes. So that's how you do it right. So how's this look? Okay. 2 hour up. Okay. This is what it's done now. You notice it's updated? It's updating, guys. You see, it's updating. It's updated over the last hour. It's updated this chart. Dude, you understand the processing power of what's going on? It's watching millions of candles for you in real time and updating. It's watching. Let me say this again. We go here. It's watching what happened after in the news, and it's updating its brain to get smarter next time we have a Fed meeting. It's not just throwing out patterns. It's watching before and after the news and learning. So you go to the 4 hour basis. Okay. Interesting. Okay, but we notice that this asset on a 15-minute chart, these are Kiwi dollar 15-minute, somewhere in an hour or so into the news, it wimps out. You see that? It wimps out. Despite the skyrocket we just saw, this pair tends to wimp out. This tends to wimp out. So I go to my chart and I casually draw this down arrow. And, oh my God. See, I'm trying to draw it properly. You saw me do it before we even got here. Right? Did you guys see me draw this even before we got there? I was trying to draw this on a higher time frame. Okay, so what did we just see based on past performance? This thing was expected to go up, and it did. Winner, winner, chicken dinner. The second thing is it expected to start wimping out after about an hour, and then in the past it tends to head back down. Will that happen? I don't know. It's not a prediction. It's you understand years of economic data and millions of candles of market reaction. And you're just better informed than everybody else. Huh? Trying to get that. There we go. Will this be the top? I don't know. I don't know. I don't know. Is that the top? I don't know. I really don't. Who knows? Okay? I really don't know. Okay? But euro dollar tends to go up for a while, and then a couple of days later, it's just game on, doing what we were probably doing before anyways. Brian's like, that's freaking cool. It is. It really, really is. And if I combine this with your prop trading account, okay. Look at just like we saw in the past. So at the very least, and this is why I was going through looking for scalps, what I mean by scalp is the news came out, you had a scalping opportunity, we went up, made, 50 pips, and then it's over. It's done. Ish kaput, ja. And we even beat the targets that traders had shown you. Remember, it's just looking at the past, right? So again, let's look at this. Before it came out, okay, euro dollar was supposed to go to 107.33. Okay, is that correct? 107.33. Let's do this. 1.0733. Shut the back door. Maybe that's not a 33. Maybe that's a 32. It's so unbelievably, ridiculously close, y'all. Look at that. And now compare it to this. Come on. Tell me this is amazing. Tell me I'm spending all this money and it's worthy of us and our attention. Reassure me I'm making the right decision. Could have spent the money somewhere else. Could have put my focus somewhere else. You're not impressed? I'm not easily impressed, but I'm impressed by that. Oops. Oh, sure, the other one's gone. All right, whatever, I can put it back. I'll take this out. Those are all trade plans. You're not impressed by that? Yeah. Do you understand? Just today, I cut a check large enough that I could have bought a car. Now, granted, a used car. But I'm telling you, I'm all in. Okay? What is the price? $79 a month? I just cut a check that is 6 figures. Is that 6 and is that a million? No. No, I just cut a 5-figure check. So I'm in it. You could be in it for 10 years and I'm in it more than you. And it's only a month and a half old. Yeah. So I hope you use it. There's been about, I don't know, maybe only a dozen, but a dozen people have signed up in the first month. They tried it, they looked around, and they quit. And I apologize because I've done you a disservice. I haven't shown you how to use it, why to use it, the way to use it, the way not to use it. But I apologize to all those, and I'm certain I can get you back. But I will add more and more and more and more value so that you will know how to use this effectively and radically change the way you trade. And so one of the things I'm doing now, and I've been working on it for days, is building a presentation that will help you like going back to what I was saying before, remove the randomness from trading. I will fix that. You will become a consistent trader. You will become a confident trader. You will have more time. And God help us, you will make more money. And with that improvement in your success as a trader, however we defined it, consistency, or letting your winners run, or an improved win rate, however we define that, once you have a track record of success, I will help you get your first $100,000 to trade. And from that, I think in a year, you compound that up to 500,000 or $1 million. And if my vision, and this is a vision statement, if my vision works out and I keep reinvesting everything that you invest into this service and adding QuantBox with it, and adding coaching with it, and adding training with it, I want to see you make 5 or 10 grand a month. I want this to be your job. I want you to be able to do this all day, every day. And then 2, 3, 4 times a year, we go to some exotic location and you and I party. That's what I want. I want you and I to hang out in South Africa in January and get a suntan and laugh. Huh? That's what I want. I want to laugh. Let's laugh. I want more laugh in our life. Cape Town or Durban? I'm thinking the Cape Town. CT, that's what I'm thinking. I've already looked up the cost of renting helicopters and flying Cape Town up into wine country so that we can have dinner and wine. I'm not even joking. I've already looked up the prices. The problem is, if I did it now, I'd probably be the only one. So imagine me flying to South Africa. I get on a helicopter, I fly to wine country, and I sit there by myself. Well, that sucks. But if we did that and we're sitting there up in the vineyard and they have tables all set up and we're doing wine sampling and they have food and maybe some music, and we're sitting there and there's 30 of us and we're looking around the table and we're amazed at how wonderful life turned out to be. How fortunate we all are to have each other. Like a blessing, as Richard says, right? That we can look around and every single one of us has radically changed our lives and the lives of the loved ones that we take care of. That's where we're going. That's where we're going. We got it. It's done. We have enough. The last piece, I suppose, I guess it's not done. The last piece is I need to bring in the prop fund. Okay? And you'll have a prop fund over there, and you'll have your own Forex account over at Trader's Way, and you'll be making a money, and everything will be great. And then when we're flying in helicopters and having dinner in vineyards, it's a tax write-off for your Forex trading business. But we trade futures as well, and this is going to be important. This is, if you're American and you're in a prop fund, you need to be able to trade futures as well as you won't be able to trade spot Forex. So, yeah, and there are Forex futures, but you also may be trading like stock indices and gold and oil as well. Okay? Yeah, Raymond's like, party for two. Yeah. So look, tell me I'm doing the right thing. Tell me I have the right vision. Tell me that you're joining me on this journey. Okay? Otherwise, I just bet on you again for this. To get this going was a giant bet, a giant gamble. And it turned out to be significantly better than my wildest dreams because I've been analyzing it and it's freaking amazing. So now I got to the next moment of truth. I have to double down and cut a 5-figure check or take a walk. And I just invested in you. Big time. It will take me years to make this back. So I need you to be in. I need you to be in all the way. This is not a halfway thing. Okay? You're not going to get halfway to successful. Okay? It's very binary. You have a ridiculous, sickening work ethic, and you might have a chance at success, but you're not going to dumb luck your way into wealth. So get big. You might not have $1 million in the account, but you can trade like $1 billion hedge fund with a quantitative analyst working for you full time and a technical analyst working for you full time. You get to do the fun stuff, trade. And if we're not on an exotic location soon partying and laughing about how amazing life turned out to be because we stuck together, then I will be very disappointed. Okay? There are exotic locations all around the world. I want you to be on a plane flying out there and say, my God, 5 years ago, if you asked me if we were going to be at a party of successful hedge fund managers sitting on the beach in Malaysia, people would have laughed. You wouldn't even have thought of a party like that. Or maybe it's somewhere else in Asia. Maybe it's Latin America. Maybe we're in London. Do you understand? Being a Harvard graduate, I'm a member of the, I'm a member of the Harvard Club because I'm a graduate. So I also have member access to the Oxford Club in London. Do you guys want to party at the Oxford Club in London? Do you know how exclusive that is? Let's party at the Oxford Club. I love Singapore, by the way. Charlie, I love Singapore. Oh, my God. I got to get back for sure. Okay? Let's party in Croatia. Yeah. It's like Italy, but half the price. So anyways, I'm open-minded to your success. Anything I can do, let's do it. But I need you to know I'm all in, and I need you to join me. Okay? This is where you put your big girl panties on and you join Traders, you join QuantBox, you join the live groups at Investor Bootcamp. Look, if you joined everything, it's a few $100s a month. Like stuff like this costs thousands, tens of thousands of dollars a month when I first started. So anyways, it's there for you. You either grab the bull by the horns and achieve your destiny, or you wimp out. Oh, it's too hard. Oh, I don't have enough time. I don't have the focus right now. I got a lot of things going on. Well, good luck to you. Have fun. Okay? Grab the bull by the horns now. Peace on earth. May the pips be with you. May our profits be above average. Have the greatest day ever. Cheers.